Recently, Paul and I were sitting down together, and Paul was sharing with me a white paper that he's written, which is fantastic. I devoured it. Why don't you tell us a little bit about yourself? I don't know that I could do justice with all the great things you've done in your
Yeah,
career.
sure. Very long story short, practice law and also got into the business side in the semiconductor industry. Ended up traveling the world, helping to stock semiconductor fabs with capital equipment. Worked for several different Fortune 500 CapEx companies like Applied Materials, KLA Tencor. And after I did that, I started up a software company, and we did what's called process control software, which basically is self-explanatory, keeps processes on track. And many industries use it. We use it for semiconductor. And the reason why I'm bringing all this up is because the work I did at my company, which we ended up selling, by the way, to a public company, the work I did at my company led me to think that a lot of the things that we did vis-a-vis manufacturing floors for semiconductor could be utilized by companies for their entire operation. And in fact, many companies do utilize something similar to what we'll be talking about today.
I mean, you have been on the M&A side with some really significant companies. I mean, you're not doing dry cleaners in a local market. You've been really involved in some really terrific companies where you got this thesis that you have and this way of working that you have, talking about the two-track leader. So could you tell us a little bit
Yeah.
about what is a strategic two-track leader?
A strategic two-track leader is, first of all, a leader who thinks strategically. And let me just go back real quick. The kinds of companies that I mostly work with are what I call lower middle market companies. Those would be companies with let's say revenues between 20 and 100 million ish, and EBITDA, which we'll talk about, between, let's say, 2 and 20 million, those kinds of companies. So back to strategic two-track leadership, it's essentially where a leader acts strategically and runs his business on two tracks. Pretty self-explanatory. So let's just quickly walk through it. Being strategic means being forward-looking, looking at the big picture, understanding how your industry is doing, understanding how the general economy is doing, understanding how your customers' industries are doing, and spending more time on those kinds of things, understanding how to build value in your business, which we'll talk about. So spending more time doing that kind of work will incur much greater reward long-term for business owners than just focusing on pure cash flow and profits.
I want to dig a little more deeply on track 2 with you, but before we go there, could you explain what is the one-page business management framework?
So this is basically track 1. Okay. So remember I mentioned closed loop control. So bottom line is what you're doing is upper left, you'll see the current business, the state of the business, and then I'm going to show you really quickly how you break your business down. But basically, this is how each area of your business is today, and you score yourself. Okay, let's say on a 1 to 10. How are we doing in finance? How are we doing in sales and marketing? How are we doing in operations and others? Okay. Then you put together in 2. You have to put together a strategic plan. Remember we talked about planning. You want to put together a strategic plan and an exit plan. So you have a roadmap. So you have a place where everybody is shooting. Okay, that's where you want to go. Where do we want to go? Then you put together a scorecard or dashboard. And by the way, as I'm going through this, a lot of business owners go, "Oh, I do that anyway." Great. Okay, then you're doing the right thing. This is just a good visual way to show them what they should be doing, and if there's something missing in how they do it, this is also just a good way to work with your people to get things done. Okay, so you put together your dashboard, which is essentially what are our goals, what are our KPIs, key performance indicators, what are our problems. Remember we talked about the daily bombardment. what are the problems that are hitting our company? Then you do the who, what, when action plans for each of them. And people have ownership and accountability at this point. Then you measure the outputs. It's essentially, how do we do? Okay. On all these actions that we you can't do everything at once, right? So you have to prioritize. How are we doing? And some of these may be weekly, some of these may be monthly, some of these may be quarterly. It depends on how you want to measure things. A lot of things in the business, in my opinion, should be measured weekly. Okay? How are we doing? And then you feed back. Basically, depending on what you found in terms of the results of your actions, you fixed something, you didn't fix something, it got better, it got worse, right? So you go back into your scorecard and you put in the data that you measured. How are we doing? Okay. Then you go back to your current state and let's just say that it was an item in operations. Okay. Did it make a difference to our operations? And if so, can we bump our score from a 4 to a 5 at this point? And it's iterative and it's a closed loop. And you just keep doing it over and over and over
You
again.
had mentioned to me something you call cleaning up your business. What does that mean?
Typically, the number one area that I recommend that you clean up your business is financially, okay? Because finance is the language of business, and buyers are going to look at your numbers first and foremost. So you need to make sure that your financials are clean. What do I mean by that? It means that they are, you've either had them audited or you've had what's called a quality of earnings. You can Google that, quality of earnings done, which buyers do themselves, which goes into your books and basically determines what is really happening in your business and making sure that your financials reflect the reality of your business and they are accurate and trustworthy for buyers.
So buyers, is there an ideal type of buyer, a probable buyer?
So there's basically 3 types of buyers. Strategic buyers typically are in your industry or near your industry, and they do what you do, or they could be customers, they could be suppliers, could be competitors. Strategic buyers, financial buyers are like private equity firms, financial firms that are looking at your company. And then there's you can sell to your partners, or you can sell to employees. You can sell ESOP or other ways. So there's 3 main types. So let's just do a quick walkthrough. Strategic is usually the best type. You want to try to find, remember I said it's like selling anything else. You need to understand the buyers. You want to find a buyer who, it's like a jigsaw puzzle, right? So the buyer's got a puzzle and there's a piece missing. You want your company to fit perfectly into that piece. And if you can find that, if you can make that, and by the way, this is what I mean by track 2 of running your company. You need to be thinking about this as you're building your company. What do buyers want? What are the missing pieces in the jigsaw puzzle? And then the more you can fit a missing piece for a buyer, the more value you're going to get, the more they're going to pay. So it's like, I call it 1 + 1 = 3. Okay. So a financial buyer, private equity firm, for example, they look at your business differently. They look at, obviously they want cash flow, but they also look at return on investment on exit, because their goal is to buy your business, put systems and processes in place and capital to grow your business, and then turn around and sell it in maybe 5 years. So they're looking on what's the value going to be on sale. And then the third kind of buyer, which is sort of the inside buyer, the partner or the family member or the employee, they are going to look, they know your industry typically, they know your company, it's what they know, and so they want to buy what they know. And so many times I've dealt with sellers that are willing to sell to one of those types of buyers for less than they would on the open market. Not very often, because once they see offers from the open market, they realize, oh, maybe I underpriced my business. But in any case, those are the 3 main types of buyers.
What are some of the trade-offs when the business owner starts thinking about track two as well?
Well, I touched on it earlier that oftentimes in track two, where you're building value, you have to reinvest in your business. So one of the big trade-offs is money. I mean, is taking money and taking it out of your pocket. You've been used to putting it in your pocket the whole time, and you have to reinvest in the business. I can give you a bunch of examples. I worked with a company that had a ERP, enterprise resource planning system, that they'd had from day one, and they'd outgrown it, and it was stretched beyond its capabilities. Well, when you go to sell the business, the buyer's going to look at that and go, well, we need to immediately put, $200,000 into your company to buy a new ERP system. And they're going to dock you that amount of money because they have to put it in right away to make the business viable, to grow. So that's an example of a trade-off of having to invest in something. You have to look at bringing professional people in sometimes, and they cost more money. So you have to invest in people. You have to invest in training of people sometimes. So those are just kind of a few examples of some of the ways that you have to do that. And another example, a big one, is what I call customer concentration. Okay, so customer concentration is a huge issue for buyers. Typically, they don't want one customer being more than 10% of your revenue or your profits. Okay, I've seen many times where business owners have one customer that is 50% plus. They started low and they just, exploded, and it's great. And they're placing all this business, and you're making all this money. Problem is, you go to sell the business, and I've literally had buyers walk without even looking at the business if a customer's 50% of their business. Why? Because I mentioned, remember the 11 areas of the business I mentioned, risk. That's a huge risk to a buyer. They won't pay for that. Some will discount, some will walk. So what do you need to do? This is a track one versus track two trade-off. What do you need to do? Well, typically what I recommend is you need to get your salespeople pounding on doors that are complementary to the one that's booming, and you need to build them up. So the one that's booming now, instead of 50% of your business, as you grow, you need to build other areas of your business up to get that percentage down. So that's another area of trade-offs between the tracks.
So grateful, Paul, to have you on this show. Thank you so much.